Hello everyone, this is Nitin, and today I'm going to use this Obstra tool to create a strategy which we can use post budget because pre-budget I am planning to deploy the double calendar strategy which I have already explained in my previous videos. You can go to my channel and check for the bank nifty and nifty double calendar strategy that I plan to deploy, which is going to be relevant till the time our budget is not presented, and to some extent even after the budget. The reason is simple that double calendar strategy helps you exploit both the situation when the VIX is going up as well as when the VIX is going down, because that strategy has got your positive vega and positive theta, the Greeks. And this particular strategy, what I'm trying to do here is thinking that post budget the VIX will go down for both Nifty and Bank Nifty. So in my previous video, I actually created a strategy where I assumed that India VIX will go down, and that's why I created a Batman strategy which can help us exploit the situation and create some profit. So let's see what we can do for and I am actually choosing to use the ninth Feb expiry date options strike prices. The reason is that those will have more premiums, and hence they can provide us bigger ranges to actually be able to ride the volatility post budget. And so first step would be just to go to the open interest position and just check what's happening for the bank nifty. In the bank nifty, if I look into the expiry for 9th Feb, you can see what people are doing here. The larger players, I would say the bigger players, are actually selling options of 43,000, 43,500, and one 44,000. So it looks like 44,000 is a good option strike price. Where I can see significant call selling. And similarly, if you go here, 40,000 is a right bottom where you see lots of people are selling P's for 9th Feb. Just move to the 2nd Feb, and here you see a greater range, and this is because of budget. Okay, so let's I think 9th Feb is more realistic. Yeah. So here, that means it is giving us the range. So let's move back to the strategy tab. Okay, this is the strategy tab. Go to the bank nifty and go to the option chain. Select 9th Feb expiry, and then we have to buy and sell the position so that we are able to capture 44,000. So let's go with 41,700. So I will buy maybe 43,000. Buy. No, 43,000 will be too far. We are at 40. So let's just give a gap of around 500 points. 41,742 for here we have around 300. Okay, let's keep a round figure. I will buy this 42,500. So yes, and here I will buy same delta. Yeah, 42,500 has a delta of 31. So let's go for same delta, just 41,000. Okay, buy it. Okay, so now you have got two strike prices here. Hmm? And so basically you are buying premium of 300, And let's see, can we sell, let's sell 43,500 so that we just be closer to 44,000. So 2, 3, 4, or maybe 5 lots. So 5 lots, and here also I am 41. So let's sell anything like this one. Sell 40,000. Again, it is closer to 100. So let's sell this one. Okay. So here is the nice strategy ready, which gives you a range of 43,860 and 39,640. So there we were getting a range as per the option open interest table, 44,000 and 40,000, right? So here we see that we have almost that kind of room here. We can even bring maybe the C part a bit closer, this one, sorry, PE part. We can, or maybe just increase, go for 6 lot. See, now you are at almost 43,900 and here 39,700, right? So this is also one way that you can manage your range. So, and keep an eye on the positional delta is 18. 18 is fine. I mean, below 30, any kind of like minus, plus minus 30 is acceptable range. Now you will notice here that Vega is in negative and theta is positive. So basically, what it is actually saying is that if the option prices goes down, so all these two positions will be in profit, whereas these two positions will be in loss. But since these positions you have higher number of lots, so and that too value wise it's bit higher, because here you are buying 300, whereas you are selling around 500 and here almost 600. So that way, in the middle also you can see you can make up till, if you remain in the expiry, 13,000. But don't wait for 13,000. If you are getting something like 7 to 8,000, maybe that should be a good profit to book. 8,000 within, I would say, 4 to 5 days. Don't keep it for exploiting the and going to the last day, because I mean, usually what I've noticed that within a week or 2 weeks, usually Nifty uh, definitely creates a kind of high range for one of the day. I mean, suppose they on maybe on Thursday, if we have closed at 41,500, and then by next Tuesday we reached something like 42,500 or something, then there is definitely a pullback towards where the week started, and that there you will again, it will bounce to maybe 2 or 3. So the idea is not to actually wait for such kind of reverse move, but if the reverse move is going to benefit you, you can wait. But if you are making a decent profit, then just book the profit and exit. So usually, what I do is my for Batman strategy, what I deploy with similar kind of 5 lakh capital. My target is 5 to 7 thousand within 5 to 7 thousand within 4 to 5 days. I mean, in a week. So if you are continuously doing it for 4 weeks, I mean 7 into 4. 28, and 28, if you just remove all the operating cost, that is your brokerage and taxes and everything, then you are still making something like 20, 25K, right? In between the range of 20, 25, I mean 20,000 or something for one strategy. So if you have a 10 lakh capital, you can easily create something like 40, 45K, right? So I think that's a decent amount of capital. Even if you do any other kind of business, you will not earn this kind of money, and that too so safely that you don't have to do much. But yes, I will also suggest that whenever you should be also be aware how to do the adjustments. And for adjustment, the simple rule is wherever your index is drifting. Suppose bank nifty is moving from 41,600 to 40,000 here, then you bring these two prices closer. The call side, both the positions you can close, because most likely they will be in profit, because you have to treat these two four positions as two different strategies. One is the call spread and one is the put spread. So if it is going downwards, and that too significantly, in order to adjust and maintain the delta, just bring this like suppose if it has dropped 1,000 points, what I would do, I would just shift these two calls 500 points ahead, lower. For instance, if I have sold 43,500 C, I will close this position and sell 43,000. Fine. And similarly, I would close this one, which is like 41,000 P, or C 42,500 C, and see if it requires me to actually buy 42,000. So that way, what it will happen, this the range from 44,000, it will shift maybe 500 points in towards in. And that way also we are increasing the theta, because the strike prices which are closer to the actual spot price, that will give you more premium. And so the theta decay will be happening more. So that way also you can actually do the adjustments. Maybe you should, that's why I always tell that try to do these strategies on paper. And this tool is very good tool where you can actually save this whole strategy as see what I will do: Nifty Batman post budget, and I will save it as paper portfolio. Okay, so it will come into paper portfolio tab here, paper portfolio. So here it is saved. Now I can watch this particular strategy as we move ahead. And I will not deploy the actual capital unless and until I am sure about it. And then, as and when we are doing this thing, as we move ahead with the number of days, so obviously when it will be in positive, you will be happy that we are making money, you won't do the adjustment. But when we start making losses, then your brain will start working that, oh yes, we need to close these positions, the positions which are in profit, and then move it slightly towards the index, towards the spot price. So spot price is the actual price where bank nifty is. Okay, so that way you can manage the whole game. So thanks everyone, and please use these strategies on paper before you deploy actual capital. And if you don't have this much capital in your hand, 5 lakhs, 6 lakhs, and those kind of stuff, you can also go with a simple ready-made strategy that this particular tool has, and you can actually still make some money. Let me just show you how to do that. Go to the I usually take this route, the strategy builder, and you have here some of the ready-made strategy. And suppose on 9th Feb, I want to do a kind of negative Vega strategy, which is going to benefit with the VIG when the VIX is falling. I will go with either Ironfly. So here I am using Nifty. I will change it to Bank Nifty, expiry date to 9th Feb. I will go with this, and this will have a limited profit, limited loss. See, so here it has a profit potential of 19,000 and a loss potential of 7,800. Now, still it's a very good strategy. Why? The risk reward ratio is only 1 is to 2.5, which is again a great risk reward ratio. So if it starts, the Nifty remains in this range, this break evens, then bank Nifty, then you are still making money. But it's very unlikely that Nifty, which is giving you this kind of huge swings of 1,000 point, it will remain in 42,500 and 41,000. That is why I was suggesting a Batman strategy, which gives you a larger range. But again, that Batman strategy has an indefinite loss potential, but here you have a definite loss, because the loss cannot go beyond 7,000. So I mean, for the small traders, you can always use this kind of a strategy, which is still going to give you some money. And here also you can do adjustment and you can actually make money. uh, so this is one way to do it. And you also have this iron condor thing. So iron fly is considered much more better hedged than the iron condor, but iron condor gives you more, I would say, more risk efficient, but then again less profitable, because here you get the range a bit, not very much significant range hike from the iron fly, but still some people prefer to go for iron counter, because they are. I have used both the strategies, and I found iron fly to be more efficient in handling the swings and volatility. So my preference will be iron fly, but iron condor also can be helpful in case of a stock strategies. So stocks which is giving wild moves and all, you can deploy iron condor, because there you may not be able to implement the Batman or double calendar in a very efficient way, because in India, the next month expiries are not that liquid, and it's only liquid in case of Nifty and Bank Nifty and some of the premium stocks like your Reliance, Adani, Maruti, SDFC Bank. I mean, some of the top stocks that they will be liquid for the next month expiry, and that too they will become liquid after 15th, not before 15th. So, I mean, just be careful when you are choosing the strategy for different stocks, and what time you are choosing it. Just don't go blindly and start selling options on any strike price and any month expiry, because option selling is a very very risky trading business, and it may just wipe out all your money, including the capital and everything. So very risky, but without risk there is no money. So you can take a calculated risk as per your risk appetite. Thanks everyone for watching this video. See you in the next video. Bye.